So we're talking about, real estate investors adjusting for the market, but we have to understand that lenders are going to do the same thing.
Yeah.
These big lenders, because you said AFIS is doing that now,
Mm-hmm.
we're going to see more and more lenders get smarter on the non-qualifying end and start allowing second homes and things like that. Now they have to be regulated a little bit differently because second homes are really kind of primary as well, or owner occ anyway.
Owner occ, yeah.
So they're going to be limited as to what they can do. But as we've been seeing the conventional loans kind of dwindle for investors and second homeowners, we've seen them expand on our end with the non-qualifying.
Yep, absolutely. Absolutely. Everyone
Every
knows,
day it's new.
Everyone knows that they cut it from 14 to 7% on what they're doing. And there's, definitely rumblings that,
they're going to do it again.
They're going to cut it in half again.
Yeah.
So that's just going to open up a bigger market share for private lenders or aggregators of capital, because you're getting I think I just saw, was it RCN? I think it was RCN. They just did it was Two Rock. Two Rock did their first securitization of long-term rental product of 200 and some million. So
that's a lot of bucks.
So there's a lot of people, a lot of capital flooding into that market.
Yeah, because it's not really, it's not where it used to be anymore. And the people making those decisions are investors. They understand our world.
It's only a matter of time before so much capital floods in, dilutes returns, and then it pulls back out. That's just what happens.
That pendulum swinging back.
I've seen on the investor loan side as low as 3.75. That's getting really close to what a bank can do.
Conventional. That's exactly right.
It's getting really
probably
close.
Better than a non-owner occupied that you would get conventional.
Well, it's definitely lower dock and probably happens faster.
Yeah,
closes faster.
That's just amazing. Keep it coming.
Yeah, we're pricing them between 3.9 and 4.5.
Yeah,
right now. It's
that's good.
And the thing is, the contrarian thought is, well, how long can this last?
Yeah,
because we have shiny object syndrome. People start throwing money into an asset because it's safe, but it's safer, perceived safer, and produces a good yield. Well, how long until that lower yield is definitely the safety of it is not a factor anymore. You're like, well, I can't really take that low yield anymore. I got to be a little more aggressive.
Yeah.
The safety doesn't matter. So let me try something else.
It'll change right back.
And that's what happens. We saw that in money into the private lending fix and flip space.
Mm-hmm.
It's still there, but I here recently the shift has been moving capital from that
to the long
term.
Yeah, which is amazing because a year ago today it was almost non-existent, wasn't it?
The long term?
Yeah.
Yeah. Oh yeah.
Non-qualifying long term was almost non-existent.
Yeah, it was tough to get before COVID, and it shut down with pretty much shut
even fix and flip did for a lot of people.
Yeah, for a lot of people. So
not us though.
but yeah, it's we'll see what happens, but I wish I had a crystal ball.
That's right. So the question was, how do you prepare for the market changes, right?
Yeah. How do you prepare?
And we'll go back to the original answer that you gave with
I say no, but you have to, there's so many different factors. I was telling Wendy and Bill this story. You take a 10,000, let's just say 10,000 incompetent fund managers, and you give them a 55% chance of losing all their money in 1 year. You give them a 45% chance of making money. And I'm not making this up. I got this from a book. So
it wasn't the internet.
It wasn't the internet. Fooled by Randomness was the book. But and so you run that scenario for 5 straight years. And what you end up with is 192, something like that, 192 incompetent fund managers who now have a 5-year track record of making money. Now, original pool was 10,000, but you still have 192 who don't know what they're doing, who still made money. So
Dumb luck.
so dumb luck. I mean, it's just numbers. So you can prepare all you want. Sometimes the market just shifts. Your portfolio isn't allocated correctly. You're in something that, that has for the last 100 years been a staple of a society that has returned good yield, and it'll never go down. And then it does.
That's right.
So, prepare
right.
all you want. I mean, I would always recommend, look at the data, use the data, look what's happening around in the world around you in your local market, adjust accordingly, and, have a little bit of luck.
That's right. And don't be afraid to make a move.
Yeah. I'm not going to stand up here and tell someone like, I know exactly what to do so that you can avoid all risk in the market.
Yeah.
Like no one, if someone tells you that,
they're full of it.
They're so full, Wendy and I work hard. We analyze deals. We analyze the market. And we still lose money.
That's right. That's right.
So
invest
money.
with us, folks.
Yeah. Now we invest in an asset type that we can control more or less the amount of loss.
The least amount of risk.
Yeah, we can control the amount of loss. So we can, like I said before, if you can control your level of losses, you can control your level of yield.
That's right.
To a better extent.
That's right.